Welcome to the EXP group. Today we're going to discuss ACCA paper F2, Management Accounting. We recommend that the candidate for paper F2 download the EXP group's express notes for this purpose and to read the introductory pages concerning the express notes, how they are structured and what they are intended to achieve. Remember, these notes are only a broad overview of the topics in paper F2. Now, F2 concerns itself with is a knowledge paper dealing with the topic of management accounting, and therefore there will be great focus on understanding costs, the definition of costs, categorization of costs, cost behavior, and so on. There's a certain level of mathematical skills which will be required in this paper, not a very high level, but those that are covered will be practiced and tested in the exam. We will also cover cost accounting techniques and consider areas of budgeting, and finally short-term decision making based on an understanding of relevant costs. If we scroll through the introductory pages, and again I encourage the reader to skim these parts of the notes to understand the context in which the express notes have been prepared, we turn to the first section on the nature and purpose of cost and management accounting. Now, we can say that management accounting is actually a further evolution of what was traditionally known as cost accounting. Management accounting is broader in scope. It's not looking only at the costs of producing things in a company, but is also concerned with the generation of revenues, the relationship between revenues and costs, and the further dimension of investment spending. At the same time, we can say that management accounting has elevated its view to adopt a higher level and more strategic view and management of a business. Therefore, the management accountant the management accounting discipline will have grown in ambition and really has taken its seat at the most senior decision-making levels in a corporation. Now, an essential ingredient in good management accounting is to have qualitatively good information. And we'd like to start here with describing the qualities of good information. One remembers the old adage, garbage in, garbage out, and therefore if one is to process data in a meaningful way and to be able to extract useful observations with regard to management accounting and to take good decisions, it's important to have good informational inputs. Now here's a mnemonic device summarized in the word accurate, which describes the characteristics of good information. Good information clearly has to be accurate, has to be complete, it has to be cost beneficial. This is something which is either assumed or possibly forgotten. In other words, the benefits that information gives you should exceed the costs of having to obtain such information. If the costs are greater than the benefits, then it's not worthwhile collecting and processing such information. So good information has to meet the test, the cost-benefit test. Good information is also user-targeted, so it's developed in mind with who is going to be the consumer of such information. It has to be relevant. It has to be authoritative. In other words, it has to be based on some credible sources to be acceptable. It has to be timely. This is another interesting and important quality. In other words, good information is sort of like milk. It has to be consumed within a certain period of time, otherwise it goes bad. So a perfectionist, for example, fights against the challenges of time. It's better to prepare a report for senior management deliberations within a short time, even if the information is not 100% perfect. Perfection can be the enemy of practicality, and therefore good information has to be provided in a timely fashion. And finally, the last element here, characteristic, is good information has to be easy to use. Now, if we move on to the question of how and where is information, managerial type information, put to use, we should take put on our organizational spectacles and think in terms of so-called responsibility centers. Now, responsibility centers can be broken down into 4 basic categories. Think of any business organization and look at it in terms of cost centers, revenue centers, profit and investment centers. Let's just run over the definitions of each of these centers and then come back to the notion of responsibility. In cost centers, we have information which is pooled, and the activities of a cost center will be concerned with the generation and of current expenses only. In other words, the manager of a cost center, his main or her main task will be to put a limit on expenditures. That would be the main task and the main objective for such a manager in such a center. If we turn our attention to revenue centers, we could have activities in a company, for example, a sales activity, where the generation of revenues becomes the main driving force. And therefore, as a revenue center, we would say that the manager there has targets to generate revenues, but not to control current expenses other than marketing expenses that relate directly to the sales efforts. If we look at profit centers, here it becomes a bit more sophisticated because now we're combining both revenues and cost centers. And speaking of a profit center, which becomes an area of a unit of responsibility within a company, where the manager in charge will be running the unit with a view to generating revenues, but at the same time keeping an eye on current expenses, because he or she wants to maximize the difference between the two, i.e. to generate a profit. So the goals of such a center will be very much profit driven, and it will be left to the discretion of the manager in charge to supervise the way in which revenues and current expenses are generated so as to produce the most beneficial effect from a profit point of view. Finally, we get to a higher level of organization called an investment center. This is building on the profit center concept, but there's one more important dimension added here, and that is capital expenditures. In other words, the manager of an investment center not only is looking for current period revenues and expenses, but has to make longer term investment decisions in order to be able to maintain the ability of this sort of units to be able to function in the medium to long term. Therefore, the investment decisions that are taken represent a higher and more sophisticated form of decision making. So the manager of an investment center, and as investment centers we can think in terms of a division within a company or a strategic business unit, something that is self-contained from the standpoint of running its business with an eye on the medium term. And if we summarize now, each of these centers have specifically delineated responsibilities with regard to revenues or costs or a combination of the two or investments as well. There's a notion of responsibility, that there is accountability by the people who are in charge of these centers to supervise and to make sure that the spending that they incur is kept under control and that business activities that are generated are done in a properly supervised way. Finally, let us come back to the concept of management accounting itself. There's a rather comprehensive definition which is offered here. I'll leave that to the candidate to read and to consider. Management accounting is effectively forward-looking in terms of taking decisions, and therefore distinguishes itself from financial accounting, which is concerned with reporting what has happened in the past. Management accounting is, in addition, aimed at internal users, whereas financial accounting, if we think of annual reports and so on, has as its principal audience external interested parties in the company. We mentioned the future orientation of management accounting. The main task of management accounting is to control the current activities of a business with a view to improving its performance going forward. Also, management accounting is kind of a freestyle accounting in that a company can choose any formatting, style, or structure of management accounts it deems useful and practical to the carrying out of its business. Management accounting structures can be influenced, for example, by the markets being served or by the industry in which the business is positioned. This is in contrast to financial accounting, which runs under accounting frameworks and standards, and oftentimes as a response is produced as a result of legal requirements. We leave the candidate to consider other ways in which management accounting and financial accounting differ from one another.